Good morning, everybody. Welcome to today's live stream event from Interactive Brokers. You can direct questions to us on our YouTube channel, LinkedIn, and X platforms, so please do so. I'm Andrew Wilkinson, Director of Trading Education here at Interactive Brokers, joined by Senior Economist Jose Torres. Good morning, Jose.
Good morning, Andrew. How are you today? Big day.
It's a beautiful day outside. It's a beautiful day. I don't think the market is in a particularly good mood as we await this consumer price index, and I haven't really checked the data, just saw a headline earlier on. So oil prices going back up, stock futures are dropping, the AI fallout from the AI trade, however long that goes on for, whether it's warranted or not, we don't know. Markets set up a little bit negatively this morning. So how much does today's consumer price index matter?
Matters a lot. This is the 4.2% expectation, would be the highest in 37 months, going back to April of 2023. That's over 3 years ago. There's an expectation that if the number is hotter than expected, yields would jump more significantly. And already we're seeing that the equity market has had trouble with the managing yields this elevated alongside of fading AI enthusiasm. So if you have even higher rates from here, with futures already down, let's see here, around 1%, you could have a 2% down day, 3% down day in stocks if you get a number above expectations at 4.3%. But conversely, you could have a beat to the downside, or a downside miss rather, and that would give you an alleviation on the Treasury complex, and that could be conducive to a rebound, similar to what we saw yesterday. Yesterday, intraday, we had a really aggressive reversal. In fact, let me open up my charts here and show you. We had a really aggressive reversal intraday. The day was looking like it was going to be positive, folks, but then something happened intraday, and part of it was Middle Eastern tensions related to a U.S. helicopter. So here we are in the S&P. This is yesterday's action. So we opened up at around 74.39, made it up to 74.80. So trying to get to 7,500. Mind you, the all-time high is up here at 76.20. Then around, we were rising a good 0.5% to 1%. And then at 9:51, all of a sudden volatility hit, and we started having a lot of selling pressure all the way up to around 12:40, hit this bottom here at 72.40, intraday bottom, and then recovered, folks, took out 7,300, took out 7,350, and ended up trying to get back above 7,400. 73.86. As you can see here, the VIX is at 22. So now we're starting to expect some turbulence in markets. Option premiums are getting bid up. There are some financial stability concerns. If we look to the currency markets, we see that the US dollar Japanese yen pair is above 160. That's a level that, as you can see, it's a level that's been defended strongly by policymakers in Tokyo. And recently, a few months ago, we heard that the Treasury Department here in the US was also involved in help with currency swap lines to help this currency pair remain below 160. Also, Bank of Japan meeting this week, Fed meeting next week. Hikes could be on the horizon. They're priced in for Japan, priced in here for the US. So the implications for this CPI report are huge. Gold tanking down 3% on the day. That's also due to now we're turning from an easing cycle to a hiking cycle, perhaps likely. So those real rates are catching a lift. So not really good for a commodity, a precious metal like gold and silver, which of course don't yield any interest. Those are trades, those are debasement trades. When central banks are too easy, folks pile into those. But when central banks start turning around and show some discipline and want to hike, then there's some selling pressure in those precious metals. So a lot to talk about. Another important thing will be the core number, which is 2.9% median estimate. Here, this would only be the highest going back to September. So if this can remain below 3, then you can continue pushing the argument that perhaps this is a one-time energy shock and that inflation will subside once oil prices go back down, because core is essentially going to reflect how much of the energy shock is now spread across the overall economy. Now, the spread has been significant, folks. We've seen it in food, we've seen it in physical products, we've seen it in services, but housing, folks, shelter, makes up roughly 40% of the CPI. And we've been seeing that with these elevated interest rates alongside immigration restriction, that's really put a lot of downside pressure on rent growth and house price appreciation growth, housing valuations. So that's really been serving to dampen a lot of those effects. Of course, housing valuations and rents aren't that directly linked to oil prices.
We hear a lot about pieces about to break out. Within a couple of days, we're going to sign an agreement with Iran, and it just doesn't happen. And the president keeps telling us that petrol gas prices will continue to fall back down to where they were pre-conflict. But I feel like we're just being told that, and it's not happening. So to me, the elevated energy prices are probably with us for quite some time. I think 3 to 6 months after, let's say, peace broke out, I think it would still take a long time for the Straits of Hormuz to open. So I think this inflation factory is with us for quite some time. And the Fed is, I don't think a single print that beats expectations at a very elevated 2x target of 4.2% is any kind of solace for investors. I'm really struggling with that argument, Jose.
No, I understand. I think that right now AI is dominating the tape, and the waning enthusiasm there is, really dominating everything. In fact, yesterday we had, here are the sectors, folks, the 11 major sectors. Folks, everything was higher except for technology and energy. So 9 out of 11 sectors higher. So this market, Andrew, is trying to rotate. I totally understand your point here, but what bulls have a very wide path to victory. So, and we've learned that in the past few years, especially in this raging bull market. So if the bulls have in their mind that this is the peak CPI, that we won't see a number above 4.2 in a few years or in a few months, then that means inflation is going in the right direction. We saw it in 2023. Those inflation numbers were elevated, but because they were moving lower, right? I was very confused and perplexed by the behavior myself, but because the inflation figures are moving lower, that was enough for the market bulls to keep buying stocks and to keep, essentially betting that interest rates would keep going lower. Now, why I think that, let's say if we start moving down from 4.2 to 3.9 or 3.5, et cetera, the base comparisons for next year start to look very favorable for inflation, because when you start comparing the $100 oil to perhaps what will be next year $80 oil, then the year-over-year comps are beneficial for a lower inflation rate next year. I think a huge factor that's going to really decide whether inflation is pivotal for the short end of the curve or not at this point is going to be next week's Fed meeting with new Fed chair Kevin Warsh at the helm, who's historically been an inflation hawk. However, President Trump, of course, wants lower rates. However, right now, with the Treasury complex where it is, 2-year at 4.13, 10-year at 4.53, the commander-in-chief could be yelling to Kevin Warsh to lower rates, but the Treasury complex is telling him they want tighter, not looser. So this is, a classic kind of bond market challenge to the new Fed chair, albeit to your point, inflation is way above target. This is a classic challenge to the Fed chair on what he's going to do. If he reflects patience on this front, which I don't think is justified, but if he decides to stand back and be cautious and doesn't want to raise rates, then we are in for a steepening yield curve where the 2-year yield will fall and the 10-year yield would stay roughly where it is, because it'll reflect the fact that the Fed is going to want to remain patient, keep the expansion alive, not sacrifice employment, and willing to tolerate for over 5 years inflation that's above target.
Let me ask from a slightly different angle, how much does the labor market need lower interest rates?
At this point, it doesn't. We're starting to see a broadening in the labor market. We're starting to see a lot of strength, which, given the concerns about AI taking jobs and the labor supply issues from the immigration, this has been a tremendous employment sector. In fact, it's consistent with this economic reacceleration we're seeing. Essentially, the AI capital expenditures have taken over the economy, Andrew. In GDP, we're seeing it. Consumer spending is softening, but the numbers at the headline look robust because of all the AI fever. Companies want to get in front of this. They don't want to be left behind. They are taking on debt to embark on these capital expenditure programs. They are using cash from their balance sheet. They are issuing secondary offerings of equity, driving down their free cash flow yields. A lot of these firms, Andrew, really going all in on the AI technology.
But labor wages not pretty much very well contained.
Wages, not run well below inflation at this point. And really a reason why consumer sentiment is so weak. And we're starting to see that the expenditures from the shoppers, from the households, are starting to slow down. Folks are starting to have to make tough choices between discretionary items like travel, like apparel, like food away from home, and prioritizing those necessities like consumer staples, food products at home from the supermarkets, bathroom products, electricity, heating, all those kinds of necessities, housing, of course. So we're starting to see that, the consumer is a little weaker here. As far as what can drive the consumer to be stronger, I think that if you have inflation starting to come down, we need oil to, the good news about oil here, Andrew, is that it was anchored near 100 for a while. It had these jumps above it, but it was anchored near 100 for a while. And now, since for the past 2 weeks or so, it's been anchored here near 90. So, these $10 increments are really important. If we do, I totally understand that the conflict is ongoing. There's continuing to be aggressions in the Middle East, and that would be conducive to higher oil prices, not lower. But for whatever reason, they are lower. There's a lot of alternative routes that have been managed around the Strait of Hormuz, and really signals economic resiliency and an abundance of alternatives when it comes to oil transports. But really a lot of different ways to get the oil across. If we can now, start to get towards 80 and anchoring towards 80, I think that's a good inflation story for the next few months, because it'll mean that this report, Andrew, is peak reported. Here we are, 3 seconds away from the numbers, folks.
Let's see what the government throws us today. Okay. June the 10th.
Equities jumping on the 4.2%, exactly as expected. 0.5 month over month. But the core number, folks, comes in lighter, 0.2% month over month instead of 0.3, annualized at 2.9%, only rising from 2.8, headline rising from 3.8 to 4.2. So equities, as you can see here, this big green candle, jumped from 73.25 on the S&P up to 73.57 right away. Let's see what yields are doing. Yields are a little lighter. The 10-year was as high as 4.55, now down to 4.52. 2-year knee-jerk reaction here really made it up to 4.18, now down to 4.12. So big moves in markets on the reaction. Equity is now pairing some of that gain. We'll look into the report now to get you some of those details.
Yeah, so energy a little higher than it was last month. It comes in at 3.9. As
yes.
3.8.
Yes, 3.9 month over month.
Gasoline up 7% month on month from a 5.4% gain the prior month. The gain from electricity is only 0.6% month on month versus 2.1% the prior month. And piped gas actually fell for a third straight month by 0.5%.
Yeah, and we're seeing food here, big disinflationary factor here. Food at home, so this is food that you buy at the supermarket, down from 0.7 to 0.1, so big deceleration there. Food away from home, slight increase from 0.2 to 0.3% month over month. Look at new vehicles, down 0.3%, second month in a row of weakness. Used cars up 0.1%. Apparel's a tariff-sensitive area. 6 consecutive months of increases, up 0.3% month over month. Has decelerated quite a bit from the 1.3% seen in February. Shelter decelerating strongly from 0.6 down to 0.3. Still high at 0.3. Would have expected this to be 0.2 or 0.1. Transportation services, big decline here. We'll have to look deeper to see why this decline 0.6 usually doesn't happen with gasoline up 7%. Of course, transportation services, gasoline, jet fuel, huge input there. So not really sure why this decline 0.6. And then medical care services up 0.5.
Looking at food consumed at home, that was has gone up quite a bit. Index of food at home rose 2.7% over the 12 months ending May for this report. The fruit and veg index rose 6.1% compared to a year ago. Non-alcoholic beverages increased 5.8% over the year. Meat, poultry, fish, eggs increased 1.8% over the year. And cereals and bakery rose 1.9%. Things that fell, dairy and related products, fell by 1%. So it's tougher for the consumer out there. Food away from home rose 3.5% over the last year. So whether you're eating in, eating out, it's certainly significantly more expensive than it was a year ago. How does that contrast to wages in the latest report?
Wages up 3.4% year over year. So, negative essentially. Consumers are being pressured here to the downside. But if you look at core, if that's a better story at 2.9%. And part of what brought core down below expectations was that 0.6% in transportation services. We're seeing now why that was. Car and truck rentals down 4.2% month over month. Motor vehicle insurance, car insurance, down 1.7% month over month. So, some decent stories there. That was able to offset the increases in airline fares, which are up for at least 5 consecutive months. They rose 2.7% month over month.
How's the yield market taking this report today? I mean, good for equities because it was in line with forecasts. But where's you say you saw an aggressive spike in 2 years? Has that calmed down now?
Yes, it was a huge overreaction, knee-jerk reaction. Well, I won't call it an overreaction, but a knee-jerk reaction. I think folks looked at the numbers, said, okay, this is hot. But then somebody looked at the monthly core and realized, okay, this is lighter than expectations. This shows that perhaps the spread of oil is being contained by softening consumer demand, or by firms saying that sacrificing margins in a short run so that transactions could flourish. 418 on twos now was the top, down to 412. See this big red candle. 418 might have been close to the highest all year, folks. 418 is close to the highest all year. The highest of the year on twos was June 8th, this Monday at around 420. Tens, not as sensitive to monetary policy actions ahead of the Fed. So we had a less dramatic reaction. We got up to 455 prior to the report on some of the Iran worries at around 7 a.m. And then around the report's time, at 8:30, we ran up to 454. Now we're at around 453 or so. So more tempered move in tens, much more aggressive on twos ahead of next week's meeting. Equities taking it in stride. I'm just going to pull the 5-day chart up. So here's the 7,500 level. We've been trying to get back above it, failing. Yesterday's low was 72.40. Right now at around 73.50. So we'll see, how equities can handle this. Volatility is lower. The VIX index, let's see, the 1-day made it up to 22.57, now down to 20.89. So folks breathing a little bit of a sigh of relief, not totally. Equity still down 40 bips, but folks a little calmed down by this number, that this core number again that really saved the day. Otherwise, you could argue that you would have had a more pronounced sell-off if you didn't have that miss on the core monthly.
All right. And what's in store with the prediction markets, Jose? They've been on fire recently. What does this tell us about the next report?
So we're going to go first. We're going to explain. We're going to have Chief Strategist Steve Sosnick he'll talk about the ForecastTrader to introduce some of you to, if you don't know about it. These are our prediction markets. We'll be back with you in a moment.
What exactly are prediction markets?
Prediction markets are a way for ordinary investors to express their views on market-related events, some of which have very important consequences for one's investing. For example, we all know that elections have ramifications for markets. With midterm elections approaching, it will be very easy for investors to decide who they think has the better chance of taking the lead in the House of Representatives, the Senate, or in any range of specific congressional or gubernatorial elections. Prediction markets make that very simple. You can speculate on these races, or you can effectively use them as a hedge on your investment positions, but doing so in a much more targeted way than one was able to do before the advent of these products. This, to me, is the beauty of prediction markets. You can express a view on something that is market related or investment related, but that has always been historically difficult to factor into prices in a direct manner.
Walk us through the mechanics. How does one trade?
In terms of the mechanics, it's really not that difficult. You buy the yes if you think that the outcome of the contract will occur. You buy the no if you think it won't. And you also exit your contract by buying the opposite contract. So if you're long a yes, you buy a no. If you're long a no, you buy a yes.
Then how does one calculate profit and loss?
Prediction markets are quite straightforward. They trade at a value between 0 and 1. And these are dollar contracts, so you can speculate a little more in terms of the number of contracts because the dollar value is low. And in terms of their percentage return, that's based on what you paid and the difference. So the leverage can be quite powerful because if I pay 40 cents for a given contract and it resolves at 1, I made 60 cents on my 40-cent investment. That's 150% return.
And what are some risk considerations?
One thing that we believe mitigates the risk is that these are financial contracts, not bets. These are financial contracts by a reputable financial firm with important financial regulation behind them. We believe that these prediction markets are a valuable tool for investors to speculate on or hedge risks that otherwise have not been easy to incorporate in one's portfolio. And that's why we feel very strongly about these products as investment tools and risk management tools rather than just purely speculative instruments.
Very well explained, Jose, I think.
Definitely.
So we're in June now, mid-year. What on the prediction markets is catching your eye for the third quarter or even year end now? How are you thinking about prediction markets?
So really thinking about it in a forecasting sense to see sort of where a lot of our participants think that the number will be at. For example, in the July report, that'll reflect this month. Still a lot of uncertainty with oil prices, only 10 days in. So we're not, folks aren't that confident if we're going to get a number below 4% or north of 4.2. But 3.8% seems like folks are pretty confident. That's going for 91 cents. And another thing is that we do have separate exchanges now being listed on IBKR prediction markets. So it's ForecastX, but also Kalshi and the CME group. So across different contracts, you'll see that some strikes are offered by both ForecastX and by Kalshi, like here in the CPI. So that's an interesting development to see how folks come to us here at Interactive Brokers and engage with the different exchanges that offer prediction contracts, similar to our traditional brokerage offering, where within stock markets, option markets, futures markets, we connect you to a plethora of exchanges all around the world to support the best execution. So it's going to be interesting to see how volumes evolve from here, how much participation grows. Those topics are top of mind for me right now.
And was there anything in today's report, and it's probably a little early because you haven't had a chance to sit down and really go through the report, is there anything in today's report that tips your hat towards what it might be next month if we're looking at the June inflation or CPI number?
No, not anything striking.
Yeah.
I think transportation services, I think we got lucky with that negative 0.6. I think that can turn to a positive next month, but that can also be countered by lower gasoline costs, which have been a welcome development. It's going to show you a chart of gasoline prices. Yeah, so 1, 2, 3, 4, decline for 4 consecutive weeks. This Tuesday report probably going to mark the 5th. We'll look to our forecast market to see what it thinks about the $4.15 level. But here in the inflation nowcast in the Cleveland Fed, this is a tool I like to look at to inform next predictions. So far, looking like gasoline is serving as a disinflationary force. We see here, for example, in the month over month, only right now, if prices over the last 10 days continue for the rest of the month, then the CPI is projected to increase 0.12% month over month, will be very light. And that'll bring the 4.2 down to 4.05, which, depending on rounding and where exactly it lands, couldn't be rounded up to 4.1 or down to 4%. And here's visually what me and Andrew were arguing about earlier from an economic standpoint, if a decline from 4.2 would be satisfactory for the market or not. And this is kind of what it looks like visually. If you get a lower gasoline price like what we've been receiving in the past few weeks, then your headlines start to see downside pressure. And then maybe this 4.2 that we got this morning for May, maybe that turns to 4% and then begins to cascade lower. Core CPI expected already to come down from 2.9 to 2.8. So if that starts going down, I think that you could be in an environment where if the Fed is too strict, that a large amount of financial professionals will start to question whether the Fed is being too aggressive, because it was just a one-time energy shock and inflation is already slowing down. I think that's going to be pivotal, especially ahead of tomorrow's, next week rather's Fed meeting.
Jose, what's the prediction market say about equity prices for the end of the year?
Take a look. Yeah, so still pretty bullish. Folks think that 8,000 is attainable around coin flip odds of 8,000 at 46.
Yeah.
84 at 19, 76 at 63, and 70.50 at 79. So folks still tilted bullish right now. The spot on the S&P, this is the futures, is at 73.53. The next month's future is, I'll get you that number later. I think it's around 7,400 or so. But, this still counting on more upside from here.
That's a nice chart, allowing you to see several contracts side by side at different prices.
Yes. We've rebranded this product from IBKR ForecastTrader to IBKR Prediction Markets, because now, we're connecting participants with many different markets. And we've essentially designed this tool in a different way to give a more visual approach to the different thresholds and the probabilities, as well as the expirations, which you can navigate here. And whatever strikes a threshold you choose here would be reflected on this chart. And then we also have a separate page that's solely for elections, to differentiate from the markets area. Of course, here you can have governorship races, Senate races, House races, Democratic primaries, Republican primaries, open primaries, general elections. So really a lot of different combinations as to what you can do with the elections page. And then in the general markets page, if you go to popular, you'll see sort of what folks are trading the most, and who's going to be the U.S. Republican candidate, the president, the Democrat side, the Fed decision, U.S. House of Representatives control. If you see the white and the green, that's going to be, or the teal. Correct me here. What is this color, Andrew? Is this like a teal, green, blue? It's a mix here for Kalshi. For white, it's going to be
teal. Sounds about right.
Teal sounds about right. So if you see the double here, that means that both exchanges are offering it. So you can go in and you can see the different prices, see what you like, see what you don't like. You can execute arbitrage transactions where you can buy yes or no in combination, for experienced folks. Then, of course, here, like a Congress balance of power combo, that's all Kalshi. Is Trump out as president? That's all Kalshi. And then some of the things are going to be all Forecast X, like the S&P 500 futures price that I just showed you. That's all Forecast X. CPI is both. Bitcoin highest price, that's all forecast X. So really a mix here on what you can see in our IBKR prediction markets. And really, we're going down to the district level on the house races, and that's quite significant to go down at the district level, not just for general, but also for primary. So a lot of depth for folks that really like to focus in on elections.
Jose, correct me if I'm wrong here, but if you open up one of those IB races there, I believe you can send them by email to your friends. I think.
Send like what do you mean by that?
Yeah, I thought there was a button on there that allowed you to send this contract. If this is your district, or you wanted to just alert a friend, you could send the whole thing by email.
Oh, okay.
From the page, which I thought was pretty cool, but I can't see it. I need my glasses, Daphne.
Yeah, I have my. Let me see. We'll look into that and we'll come back.
We'll investigate that one for next time. Yeah.
And that's what happens here, folks. We're moving so fast and trying to fulfill the needs of everyone that sometimes we're embarking on this email program, and we're not sure where it's at yet, but we'll get you informed on that in a few weeks.
Okay, Jose, I think it's about time to wrap up. Give us the headlines again, the market reaction, and we'll wrap it up there.
Yes, absolutely. Yeah, so the S&P. Sorry, go ahead, Andrew.
I was going to say, so CPI for the month came in at, as expected, 4.2% year over year on the headline basis, and at 2.9% for the core elements. And the impact on the market today
is that equities are still red, but bouncing notably from the lows of the pre-market. Volatility levels subdued on a relative basis, down to 21. Highest it was of the day was 22.53. So turbulence, could be around the corner here. These are high levels. 22 can become 25, can become 30 quickly, which is typically associated with some downside in stocks. Stocks made it down to 72.97 earlier. Low of yesterday was 72.40. So still trying to maybe get 73.50 back. Next stop would be 74, then 75, then 76, and all-time high would be 76.20. So really, quite far here from all-time highs. Seeing the impact of those those heavy down days that we've had. For example, here last Friday we had that nasty day, and then yesterday we had another bout of volatility. So here it looks like we're making some lower highs here on the S&P. Lower lows as well. So it'll be interesting to see if we start to test these moving averages here. The 50 days at 72.32, the 100 days a little bit above 7,000 at 7,009, the 200 days down at 68.83, 10s down to 452, 2s to 411, gold down, silver down, energy up a little bit, crude oil on the back of that aggression between Iran and U.S. overnight. However, President Trump keeps talking about a deal. So markets, really paying more attention to the White House rather than what's happening on the ground.
Final question for you. Do you feel like we've reached peak inflation here?
I think so. The costs going into the midterm elections are too elevated for the Republican Party. They need to bring gasoline prices down one way or another. I think something will happen with Iran, where this extended ceasefire brings oil back down to $80. The global economy, unbelievably resilient, able to handle the Strait of Hormuz closure, folks, for over 100 days, oil at $88. That's something that a few months ago, myself included, we would not have been able to fathom, but here we are. I think this is the peak number at 4.2%. I don't think we get above that for quite some time, especially with this yield curve posing restriction on the economy. We saw that in new cars, used cars continuously slowing, shelter slowing, housing valuations very modest at 1.2% year over year roughly, and then rent growth, you're really non-existent in a lot of American cities, and overall very, very tempered. So 4.2, I think that's peak inflation. I think that we can go sideways here in the market, maybe go down lower, but that, especially if we get a hike or two this year, which is priced into the curve, that'll bode well for next year, because Chair Warsh would be able to cut, if he hikes a few times this year, cutting next year becomes a higher probability. Right now, we're at 350 to 375, 43% chance we hike once, 63% chance we hike twice, and 70% chance we hike 3 times, 70.2% chance roughly we hike 4 times. This is by the December meeting. So if you start hiking and oil prices are going down, then next year the Fed is set up to start cutting, and that could be a good news for the equity market. And we already went up roughly 11% on the S&P at the highs. So we're having good equity performance despite this volatility here. The S&P, even with is still up 7% year to date. It's not even halftime yet. So we're still having a really good year for corporate earnings and for stocks, irrespective of what's happening with inflation, with oil prices, and with the change at the Fed.
Brilliant. Let's leave it there. Jose Torres, Senior Economist for Interactive Brokers. Thank you for joining me on today's live stream. We'll see you all soon.
Thank you, Andrew. Talk to you all soon. Take care.
Bye. Bye for now.